Alright guys, so chapter 6 in the ETF book is Market Indexes and Custom Indexes. I'm going to start from the beginning. I gave you guys some handouts. We're going to talk about those in a few minutes. The important handout to have during this slide, though, is the handout I have on benchmarks. So we'll talk about that. So, indexes. This is from the ETF book, like I said, but it applies to anything. Okay? ETFs attempt to track the performance of an index. Right? That's all ETFs do. They're going to track the performance of an index. Most of the time we associate them with a standard index, like the ones we have here on this piece of paper, which include the New York Stock Exchange Composite, the Dow Jones, the Russell indexes, the S&P 500, the S&P indexes, the Willshire Indexes. Something that's not on this sheet that's also very relevant is the Msci Indexes. So we're going to get into that a little bit. How do indexes weigh securities? It's a relevant question. So one of the topics, I think it's on the next slide, is talking about one of the first indexes ever produced and why was it produced. Okay. Anyone know what the first stock index was?
Dow Jones.
The Dow Jones. Created by? Charlie Dow. His name's Charles Dow. This is his real name. I call him Charlie. We're good like that. It was created in the mid-1800s, so he doesn't mind that I call him Charlie. Okay? And what was it used to do? It was used to be a yardstick, a measurement tool for the performance of the entire market. The Dow is not a very good index in general. It's something they flash on the news, but it's not. Most mutual funds would not benchmark themselves against the Dow, and we'll get into that. They want to know why?
Because of the price weighted index.
It has to do with the composition of the index. So when the Dow was composed, originally it was only 12 stocks. Charles Dow took the 12 biggest stocks, added them together, added up their prices, and that was the value of the Dow Jones Index. It hasn't really changed that much. If someone wants to look up on their phones, just tell me how many stocks. 30. I think it was 32, yeah. Around 30 stocks in the Dow Jones Index. 30 is an interesting number because statistically, and this is not a quiz question, 30 is the lowest kind of sample number you can use for statistical purposes. So if they do some kind of survey and they want to do a sample survey, 30 is the number that they'll use for a minimum. When they say, like, 2 out of 3 doctors agree that, Crest toothpaste is the best toothpaste around, they only have to sample 30 dentists, for that kind of thing. And I'm getting a little off topic here. But 30 is a relevant number in terms of a sample size. Is that a good sample size? No. Right, Jones? It's not. Why?
It's like, if you compare it to the other indexes, it's too small.
How many stocks are there in the stock market? Thousands, right?
Yeah.
So, the top 30 might not be, it's definitely not representative of the entire economy, and it totally ignores small caps. What are small caps? Small caps is short for small capitalization, which is also another name for small companies. If you have a stock index that only measures the 12 largest firms or the 30 largest firms in the US, small businesses could have a very different financial outlook than big businesses, right? Or do you guys disagree? Nothing? No opinion on this? You guys make me look bad in the video. Okay? Yeah, it's a bad representation. No organization is going to benchmark themselves against the Dow Jones. In fact, there probably aren't too many ETFs that replicate the Dow Jones. In some ways, the Dow Jones is a good index, but in other ways it's not. We'll get into that in a little bit. So there are 2 types of indexes, market indexes and custom indexes. A custom index is basically just an investment strategy. An investment strategy just used for ETFs, primarily. And then what are market indexes? We just answered that. So we'll go to the next slide. So definition of a market index. As I said, began in the late 1800s by Charles Dow. It was an indicator of 12 equities added together. So just these 12 stocks added together, that was it, that was the index. At the time though, in the late 1800s, there wasn't nearly as many equities as there are today. So those 12 equities actually might have been a better representation at that time. Talking about valuated methods were introduced in the mid-1900s. Valuated, when we say something's valuated, it's a way of measuring its weight in the index. So the Dow Jones is an equal weighted index. You're just putting the price, if one stock is $30 and the other one's $45 and the other one's $300, you're just adding them up and calling it the Dow Jones, right? But is that the best way to do it? As we talked about before, is price alone the best indicator of the value of the stock?
No.
Why?
It all depends on like the
Depends on the
value.
Yeah, the price of the stock is kind of an arbitrary number, right? As we said before, when I did that example a couple weeks ago on the whiteboard about, we're going to release a stock. And whether we price the stock at, we're making the decision to price the stock at $10 a share or $100 or $1,000 a share, right? But the price is really a meaningless number. We really care about the movements, percentage-wise. That being said, when we make an index, we want the weight, the size of the company to determine its weight in the index. So the definition to what a valuated index is in the two words right there. It's weighted by its value, right? So we'll have a company like Apple, right? And this is, I think I brought an article about this in a couple weeks ago. There's a big issue with Apple because it's doing so well as a stock. And it's now the largest, goes back and forth on a weekly basis, but it's arguably the largest company now in the world, okay? So, the performance of Apple on a daily basis is going to have a heavy weight in any valuated index that it's in. Does that make sense? Right? Because Apple's the biggest company, it's going to have the largest weight. So it's still calculated based on its price, but it takes the price of each security and then multiplies it by the shares outstanding. So that's a formula that we're not going to test on. I want you to understand the concept, but not necessarily, I'm not going to have you compose an index on a quiz. Market indexes are meant to track the performance of the financial markets. So when we talk about just regular market indexes, it's supposed to give us an idea about a yardstick measurement of where that particular style or sector or geographic region is financially, right? They're usually based on the natural state of the market. So most benchmarks are going to be a very broad-based sampling of the market. Now they can break down indexes. Like we can have the S&P 500, and then we can have the S&P 500 telecommunications. So we're breaking down the S&P 500 into different styles and sectors or geographic regions. But in general, the broad-based index is going to be passive, and it's going to measure the natural state of the market. Does that make sense? Okay. And the last thing, what is a market index? It's a benchmark. Mutual fund companies, institutional asset managers, ETFs, they're going to use them as a benchmark to measure performance by. Because as we said in the beginning of the semester, just because your mutual fund lost 10% doesn't mean it's doing bad if the rest of the market or the benchmark lost 20%. You would actually be doing good compared to the market. And that's how you should look at your mutual funds. Right? Definition of custom indexes. Custom indexes are not market indexes. That's obvious, right? They are not intended to measure financial performance. Custom indexes are simply investment strategies. Okay? They are created for commercialization of financial products, primarily ETFs. I don't want to get ahead of the slide, so I'm just going to flip ahead to the next one. I have some more stuff to add on custom index that I'll get to in a second. But characteristics of a good market index. Okay? Simple and objective selection criteria. What's the selection criteria for the S&P 500? 500 biggest companies, I think it's in the U.S. That's what it is, right? So we know what it's going to be, right?
What do you think this one, Fortune 500?
Huh?
Taken from the Fortune 500 companies? How do they select those?
How do they select what?
Biggest companies. How do they
Based on
select
market cap, based on market capitalization. So that would be the value of the share multiplied by. You're going to put me on the spot.
shares?
What's that?
Outstanding shares?
But based on the not just the outstanding shares, but just the entire value of the company, right? So we know what it's going to be measured by that, because not every company puts every piece of their company for sale. So like when Facebook does their IPO next month, right? They're not going to put 100% of Facebook on the stock market. Why?
Because they will lose control.
They'll lose control. So how much are they going to put on the market?
49%.
Is that how much?
Yeah.
No, I think I thought you knew. I think it's 10. I think it's around 10%.
Possibly.
Yeah, they're going to put around 10%. And why are they going to do that? Well, it'll give them a good idea of what the value of their company is, right? And also will give them the flexibility to issue new shares. Because when you issue shares for the first time, you're kind of just like putting your foot in the water to see what it's worth. But once the stock is already on the market, when you go to sell like a second issue of shares, like let's say Mark Zuckerberg doesn't want to sell his shares in the IPO. He's going to wait until the second issuing to sell some of his shares, right? That way, it won't be a question on what they're worth. He won't be putting them on the market and saying, I wonder what they're going to go for. He'll be putting them on the market knowing exactly what they're selling for, because they're selling for whatever the market price is. So anyway, simple and objective criteria. Comprehensive. Comprehensive is why the Dow Jones is not a good index. It doesn't have a big enough sample size, right? The S&P 500 is a good sample size of stock indexes. Let's look at this sheet for a second, okay? And we'll go down to the Russell 3000, okay? Russell 3000 index measures the performance of the largest 3,000 companies representing approximately 98% of investable U.S. equity assets, okay? The Russell 3000 index is constructed to provide a comprehensive, unbiased, and stable barometer of the broad market and is completely reconstituted annually to ensure new and growing equities are reflected. So the Russell 3000 is basically the indicator of the whole stock market, right? When we're talking about the Russell 3000, the whole U.S. stock market, okay? That is basically comprising 98% of U.S. equities is pretty close to 100. It pretty much includes everything but the smallest 2% of companies that trade on the stock market. One reason why they might not include those smallest 2% of equities is because of liquidity issues, right? When we have a stock that's really small company, it's not going to trade very often. If it doesn't trade very often, it's not good to have it in an index. So being comprehensive is a characteristic of a good index, okay? Replicable, okay? You're easy to replicate, and that's where I get into liquidity issues, right? You don't want to have a stock index that you can't replicate. Like if you have stocks that are in the index, you actually want to be able to buy them easily, right? If you include illiquid stocks in the index, it's not going to be easy to replicate. And if it's not easy to replicate, it's not really a valid index. Does that make sense? Okay. Stability. Now, we talk about stability. We're not talking about is this going to break, right? We're talking about why is the S&P 500 stable? Why is it a stable index?
Because those companies that are in there are likely to grow and not fall under.
Yeah, pretty close. The S&P 500, how often does the top 500 companies in the U.S. dramatically change? No, they don't have, it doesn't happen that often, right? So maybe every year, I think they reconstitute the S&P 500. By reconstitute, I mean kind of like reevaluate the S&P 500 every year. And when they do that, 5 or 10 companies might go off, and another 5 or 10 companies might come on. I think like Verizon got added to it a few years ago, and a company called like International Paper left it. I remember reading something in the news like that a while back. It's not new by any stretch of the imagination, but it shifts. But it doesn't shift dramatically. And this is important for people who make ETFs, because when the benchmark changes, guess what has to change, happen to their portfolio?
It has to change.
It has to change. And is there a cost associated with recreating the portfolio? What kind of cost? Trading, right? If the Verizon drops out of the S&P 500, and you're trying to replicate the S&P 500, you're no longer going to want to hold Verizon, so you're going to want to sell whatever that security is that left the S&P 500, and then buy whatever the new security is. You don't want rapid changes in the index. Okay. Now let's look at another one on this sheet, the Russell 1000. Okay, the Russell 1000 index measures the performance of the large cap segment of the U.S. equity universe. It is a subset of the Russell 3000. So there's a lot of indexes that are subsets of another index, right? So continuing on, it includes approximately 1,000 securities of largest based on a combination of their market cap and current index membership. The Russell 1000 represents approximately 92% of the Russell 3000. Now that might not make perfect sense at first. How could the Russell 1000 represent 92% of the Russell 3000?
It's replicated in it or something?
No? This is how that math works, right? So basically what it's saying is the 1,000 largest companies in the US are 92% of the market based on weight. The smallest 2,000 companies in the US only account for 8% of the market. Does that make sense now? Yeah, so it's all based on what? Value. Value weighted, right? So that's how the 1,000 largest companies have the heaviest weight. Now we look at something else, we're going to go one up. The Russell 2000 index measures the performance of the small cap segment. Guess what? The Russell 2000 is the smallest 2,000. And the Russell 3000 is the combination of the Russell 2000 and 1000 combined. That'd be a good quiz question, right? Easy, it's easy though, right? The Russell 1000 is the 1,000 largest companies, approximately. Controls 92% of the market. The Russell 2000 is all the small companies. All the small companies in the US, at least in terms of this index, only account for 8% of the market cap. Now, there are other indexes that measure things differently. Now, we're talking about valuated indexes. We could have an index that's equal weighted. So every company in this other index we create, this custom index, we can have it to be value-weighted. I mean equally weighted. And it can be equally weighted Russell 3000 index, which weighs, I can't think of an up-and-coming company that's a small stock, but it could be like, comparing Pinkberry stock to Apple. They'd be weighted equally. Should they be? Probably not, but we could weight them all the same, right? Then they can be further broken down into growth and value. Growth and value are typically fundamental characteristics. Okay. We have the Willshire indexes down the bottom. The Willshire 5000 is the total market index. It's the broadest index in the U.S., measuring the performance of every single stock in the U.S. Okay. Typically, from an investment management point of view, the indexes that I see clients using most often aren't on this sheet. They're typically the Msci indexes. The Msci stands for Morgan Stanley CI. I don't know what that stands for. If someone look it up for me on one of your phones. This is how we get interactive now. It makes it easy. I just tell you to look it up on your phone, right? Okay. The Msci indexes are international indexes. And as we live in a globalized world, it's more important to use a global index, right, than just necessarily a US index. Because if I'm an institutional investor and I'm looking for the highest return on my money, I'm going to try to take the leash off my portfolio manager and kind of let him or her make as many decisions on their own as possible, right? Because they're just trying to what? Get me the highest return. So that being said, we want to measure against the global market, not just the US market. If I have the ability to invest globally, why shouldn't my performance be measured against a global market security list? Right? Right, son? Okay. Relevance. It has to be a relevant index. We're not going to create an index on some obscure category, right? It wouldn't be beneficial. So, what do I mean by an obscure category? Well, I'm not going to have an index. I'm trying to think of an obscure index now. They don't exist because they shouldn't. But an obscure index would be something like, we wouldn't create an index that is 1,000 largest companies that pay over 5% dividends and are located in the western US, right? It's obscure, it's meaningless, right? We're kind of pigeonholing our index too much where it's no longer valid, okay? And I put it back in the slides. And barriers to entry. This kind of goes back to being comprehensive and replicable. Barriers to entry, we want to make sure that if we're creating an index, we don't include stocks that you can't buy, right? So, for example, in China, there are some stocks that foreigners cannot buy, right? You have to be a Chinese citizen to buy them. But then they may have something called like H shares, H like the letter. And H shares are for foreigners. But you want to make sure that you have the ability to buy the stock. Because if you have a benchmark that can't be validly used as a benchmark, then it's no longer valid, right? It'd be like if I was comparing houses, right? I like using houses as an example. You guys know that. And I'm not going to compare my property to the values of, properties in my neighborhood in the 1980s. Wouldn't be valid, right? I can't go back and buy a house in the 1980s, right? So it would be a poor decision to kind of use that as a benchmark for what my house should be worth.
Can I mention the name?
What's that?
What it stands for?
Yeah, what is it?
It's Morgan Stanley Capital International.
Capital International?
Yeah.
So, last thing on this slide right here, characteristics of a good index. This is not created by the SEC. These are not laws. They're not rules. You can create an index on anything that you want. These are actually, these guidelines were created by the CFA Institute. Remember that big book I showed you guys that I'm studying? These guidelines are created by that organization. That organization, the CFA Institute, acts as, they're not a regulatory body because they can't pass laws or do any kind of oversight, but they act as kind of a recommendation body, like a best practices body. Okay. Details on market indexes. Okay. Securities are generally passively selected, as we said. No one's saying in the S&P 500, we need Pinkberry to be in the S&P 500. Bless you. We're making that decision. No. Pinkberry would only be included in the S&P 500 if it reached a certain size. Right? Little turnover, like we said. There's not going to be a whole lot of turnover in the S&P 500. What do I mean by turnover, just in case you guys don't know? Changes. Yeah, there's not going to be a whole lot of changes in the index. Right? There can be some. But the industry's not going to have, the index isn't going to have a 30% turnover. Right? 30% of the stocks aren't going to change month over month or year over year. Some indexes, as we just talked about, include all securities, but most include a sampling of securities as a representation. Okay? Security selection overlaps between market indexes. What do I mean by that? Well, that's the example I gave with the Russell 3000. The Russell 3000 is comprised of what?
The combination of 2000.
Of the combination of the Russell 2000 and the Russell 1000, right? So that's where the overlap is. And guess what? The S&P 500, which is a totally different company than Russell, is going to have a lot of overlap with the Russell 1000. I'm sure all the companies in the S&P 500 are in the Russell 1000. Why?
More than 500?
What?
Companies.
Because it's both are measuring the largest companies in the U.S.
Yeah.
The S&P 500 is measuring the largest 500. The Russell 1000 is measuring the largest 1,000. So of course there's going to be an overlap. The difference is that the Russell 1000 is going to have a bigger sample size, right? The Russell 1000 is a much more common benchmark than the S&P 500 in general. Okay. Market indexes are cap weighted, which basically means weighted based on market value. Okay. Indexes can be broken down into style and sector. I think I've said that about 24 times throughout the semester. Right? We could have the Russell 1000. Even here they have it broken down a little bit, but there's further ways to break it down. Russell 1000 growth, Russell 1000 value, 2000 growth, 2000 value. They can be broken down into different industries like, hardware and software, real estate. They can be sliced and diced any way. If we had a private equity fund that invested in only real estate, what would we want our benchmark to be? The Russell 1000? The Russell 2000? The Russell 3000? Or would we want to choose something like the Russell 3000 real estate? Right? That's what we want to have. We want our index to match our investment objective, right? So if we're in a private equity fund or a mutual fund that invests only in real estate, we'd want it to be benchmarked against what? An index that's related to real estate. If we benchmarked our real estate investment to energy, it wouldn't make any sense, right? It would have no relevance. The two would have no relevance matching up together, right? Because as we know, benchmarks are going to be used for what? As a yardstick for measurement. So that brings us to this: uses for market indexes. They're a basis for academic research. When economists or PhDs do research on the economy and they look back 50 years and they try to look for market trends or areas they can exploit for investments. Now, there's that big disclosure, like whatever happened in the past, there's no guarantee that it will happen in the future. And you don't want to do something called data mining. Data mining is looking for patterns in the past that may or may not be true, right? There's like these semi-famous wives' tales, old wives' tales about, people who have these crazy investment strategies that don't make any sense, but might work, or historically might have worked. Like, I buy stocks when it's sunny out, and I sell when it's raining, Could that be a valid investment strategy? Could it work? Yeah, I mean, it's a strategy. I don't know if it's a real strategy. Could there be some kind of psychological factor that the stock market's more likely to go up when it's sunny out in New York?
Possibly.
Possibly. Is it going to be true all the time?
Not necessarily.
No, but could it beat the market? It's possible, right? But that's not a valid strategy. If you would go to a client meeting and try to sell an investor on that investment strategy, you'd probably get laughed out of the room, right? And maybe you could pull out a graph and say, look, I have all this data here that when it's sunny out, the value of the market generally goes up. 7 out of 10 times the market goes up when it's sunny out. But is that valid? No. Okay. Of course, used in asset allocation decisions, right? Why is it used in asset allocation decisions? Because that's where the performance is measured against. So when you're deciding how to beat the market is what? The market is the index. So you might say, okay, we believe the technology sector is going to be strong this year. The S&P 500, or the Russell 1000, has a benchmark weight of 4% in technology. Since we believe that technology is going to do better than expected this year, we're going to overweight technology. And we're going to have 8% of our portfolio in technology, right? On the other side, let's say we believe that consumer goods is going to do worse this year, right? So we would then say, all right, well, The Russell 1000 benchmark has a 9% weight in consumer goods, like paper towels, napkins, paper plates, whatever consumer goods are, right? We're going to have an underweight in consumer goods because we believe that that sector is going to underperform this year. So instead of having a 9% position in our portfolio in consumer goods, we're going to have a 3% weight in consumer goods, right? And then we might pick stocks within consumer goods based on that weighting. That's called taking a top-down approach. I'm not going to quiz you on that one, right? But you're looking at the top, you're saying, all right, we're going to decide our weightings, right? And then we're going to make our stock selections, okay? And a benchmark is for active strategies and just for fund management. What they mean here is if we have a mutual fund, typically are all active, right? We're going to measure our performance based on the benchmark. And if we have an ETF, right, the ETF isn't going to be use a benchmark for performance measurement. It's going to use the benchmark for tracking purposes, right? Details of a custom index. The majority of new ETFs track custom indexes. Now, why would new ETFs track custom indexes? It has to do with the state of the industry. How many companies do you think have done an S&P 500 ETF? Do you think we could create an S&P 500 ETF and be successful?
Yeah, it's possible.
It's not possible.
Why not?
Because the market's saturated. State Street Global Advisors was the first one to enter that market, and anybody who wanted an S&P 500 ETF bought that one. And guess what happened? Then like Barclays created one, and some people bought that one. And then another company created one, like BlackRock. And guess what happened? Some people bought that one. But it's less and less and less of the, less and less. If we live in a town and there's no pizza places, and we open up a pizza restaurant, is it going to do well?
It will, but...
Of course.
Yeah.
Now, if we open up a second pizza restaurant, is that going to do well?
It'll take away from the first one.
Okay. Once we open up our 20th pizza restaurant, how good or bad is that one going to do?
It's going to be worse.
All things being equal, we're pretending it's all the same pizza, right? It's not going to do as well anymore, right? You've saturated the market with the product. So basically, all the standard benchmarks are taken. And by taken, I mean you could still, in theory, create a new ETF that's based on an existing benchmark that 3 dozen people have already done. But you won't be successful at it, right? So what they have to do now is create these custom indexes, right? That are basically designed for a specific goal. So, for example, we might have a Chilean commodities index that doesn't exist, but we create that index so that we can replicate it and sell it. Because Chilean commodities could be a hot topic. Chile has a rich commodities market. There's a market for that for people who want to buy commodities. It might be hedged against the Chilean peso, which may or may not be a good strategy for us. So we'll create that custom benchmark, and guess what? That's why we do it, right? Now, could we be successful if we created an ETF based on Chilean commodities? We'd be more likely to be successful creating an obscure index than doing something that everyone else has already done, right? And that's just like the pizza place, right? If people have opened like 15 pizza places, guess what? Probably not a good idea that we open a pizza place. We might open up, guess what? We're going to open up a fine dining restaurant. Why? Because it's going to attack a different piece of the market, right? Same thing goes from the business side of creating a new ETF. Now the ETF market is still expected to grow, but it is very saturated. You have to, be very specific about where you go and what you create in a custom index for an ETF. And not all your obscure ideas are going to work either. I know a couple of years ago they tried to create state-based ETFs, like a Massachusetts company ETF or a Texas company ETF, and no one bought them. I think the break-even point for an ETF and this is in the book somewhere, I think it's around $100 million. You need to have $100 million invested for you to start making money. Which sounds like a lot, but from an investment point of view, it's not really a whole lot. Like, in my company, most of the clients are invested. You know, I'd say more than half the clients we have have over $100 million invested. Which sounds like a lot, but when you start looking at these companies, you know, balance sheets and see how much cash they have, you know, it's not surprising that they have this money invested for pensions or 401k plans or things like that. Okay? Fundamental indexes are also custom, right? We could create an index based on price to sales ratios. I want to create an index that is comprised of companies in Western Europe that have a price to sales ratio of 2 or higher, for whatever reason, right? That's just the index I want to use. So guess what? We'll have an index provider create a custom index based on our guidelines that will include companies in Western Europe that have a price to sales ratio of 2 or higher. For why we want that, who knows? But that's how and why custom indexes are created. Okay. The SEC, as I said, has no definition on what an index is. The CFA Institute created the guidelines for a good index. Okay. And that's it for Chapter 6 in the ETF book.